CrowdStrike stock is trading at $324.41 and is up over 152% in this past year alone. Shares are up because they just had 4 consecutive quarters of positive net income and has been growing at an average rate of 647% per quarter for the last 4 quarters. And to give you some reference, at a 100% per annum growth, which I think is a more conservative projection, over a 647% per quarter, there's about 3 years of growth built into this stock, assuming they can double their annual net income year over year for the next 2 years, which honestly could very likely happen. Analysts are putting their 1-year price projections at $394.36 on average, which is about a 20% upside. However, from what I'm seeing, their projected EPS for 2026 is $2.50 a share, compared to today's at 49 cents a share. Their current PE ratio is an insane 662, and if they were to see this valuation at a $2.50 EPS, it would mean a stock price of $1,655, which is a 410% upside. Now, obviously, it's likely the valuation is not going to stay that high for that long, and so I'm going to use a valuation of about 200, which is between CrowdStrike's current valuation and the technology industry average of 45. At a PE of 200 and at that $2.50 EPS mark, that would give us a share price of $500 in 2026, or a 54% upside. Some other good signs are a debt-to-equity ratio of 0.32, and remember when I said that they beat their last 4 quarterly earnings calls? Well, that was by an average of 18.1%, which is absolutely phenomenal. Really, the only 2 red flags I'm seeing are the valuation at 600 is just ridiculous, and the fact that the CEO and CFO just sold tens of millions of dollars worth of shares. However, at the current valuation of over 600, who can blame them, honestly? And as far as valuation goes, as high as it is, I think that's largely going to be offset by the stellar earnings growth. But realistically, like I said, it can't stay that high for that long, and that's why I chose a 200 PE for 2026. Although we may see this go down even further to the $100 to $150 mark, and if they can keep up with their earnings projections, then it at least helps mitigate the risk of their high valuation, because if they can reach a $2.50 EPS by 2026, their break-even valuation ratio would be 129, meaning as long as the PE ratio stays above 129 by the time they reach a $2.50 EPS, then investors are making money if they chose to buy the stock today. How likely is it that it's going to stay above that 129 mark? I'm not sure, but earnings growth is certainly there, and as long as investors are aware of how high the current valuation is, then I think I've done my job. But both the current valuation in conjunction with the fact that CrowdStrike's going to need to meet their really, really high earnings estimates just introduces too much risk for me personally.